Have you ever wondered how the Federal Reserve influences your daily financial decisions? From setting interest rates to controlling inflation, the Fed plays a pivotal role in shaping the U.S. economy. Understanding its functions can empower you to make informed financial choices. In this video, we'll delve into the core responsibilities of the Federal Reserve and explore how its policies directly affect your wallet. Whether you're a student, professional, or retiree, grasping the Fed's impact is crucial in today's economic landscape. What is the Federal Reserve? The Federal Reserve, commonly known as the Fed, serves as the central bank of the United States. Established in 1913 to ensure a stable and secure financial system. It comprises the Board of Governors in Washington, D.C., and 12 regional Federal Reserve banks spread across major cities. This decentralized structure allows the Fed to balance national and regional interests effectively. The Federal Open Market Committee, FOMC, a key component of the Fed, is responsible for setting monetary policy, including interest rates. Operating independently within the government, the Fed's decisions do not require approval from the President or Congress, though it remains accountable to both. By understanding the structure and purpose of the Federal Reserve, individuals can better comprehend its influence on the economy and personal finances. The Fed's dual mandate: employment and inflation. The Federal Reserve operates under a dual mandate, promoting maximum employment and maintaining stable prices. This means the Fed aims to create conditions that foster a strong labor market while keeping inflation in check. Balancing these objectives can be challenging, as actions to boost employment might lead to higher inflation, and measures to curb inflation could slow job growth. For instance, if unemployment rises, the Fed might lower interest rates to stimulate economic activity, encouraging businesses to hire more workers. Conversely, if inflation is too high, the Fed may increase interest rates to cool down spending and price increases. This delicate balancing act requires careful analysis of economic indicators and forecasts. By striving to fulfill its dual mandate, the Fed seeks to ensure a stable economic environment conducive to sustainable growth. How the Fed sets interest rates. Interest rates are a primary tool the Federal Reserve uses to influence the economy. The Fed sets the federal funds rate, which is the interest rate at which banks lend to each other overnight. Changes in this rate affect borrowing costs for consumers and businesses. When the Fed raises the federal funds rate, borrowing becomes more expensive, which can slow down economic activity and reduce inflation. Conversely, lowering the rate makes borrowing cheaper, encouraging spending and investment. These adjustments ripple through the economy, impacting mortgage rates, credit card interest, and savings yields. By manipulating interest rates, the Fed aims to either stimulate the economy during downturns or cool it off during periods of rapid growth. The Fed's role in controlling inflation. Inflation, the rate at which prices for goods and services rise, can erode purchasing power if left unchecked. The Federal Reserve monitors inflation closely and uses monetary policy tools to maintain price stability. One of the primary methods is adjusting interest rates. By increasing rates, the Fed can reduce consumer spending and business investment, slowing down the economy and easing inflationary pressures. Additionally, the Fed may use open market operations, buying or selling government securities to influence the money supply. Through these actions, the Fed strives to keep inflation at a moderate level, ensuring that the economy doesn't overheat and that the value of money remains relatively stable. How Fed policy affects your savings and loans. Federal Reserve policies have a direct impact on personal finances, particularly savings and loans. When the Fed raises interest rates, banks often follow suit, increasing the rates on savings accounts and certificates of deposit, which can benefit savers. However, higher rates also mean increased borrowing costs for loans and credit cards. Conversely, when the Fed lowers rates, borrowing becomes cheaper, encouraging spending, but savings yields decrease. Understanding these dynamics can help individuals make informed decisions about when to save, invest, or borrow. For instance, locking in a fixed-rate mortgage during low interest periods can lead to significant long-term savings. Staying informed about Fed policies allows consumers to strategize effectively in managing their personal finances. The Fed's influence on employment and wages. Employment levels and wage growth are closely tied to Federal Reserve policies. By adjusting interest rates, the Fed influences economic activity, which in turn affects job creation. Lower interest rates can stimulate business investment and expansion, leading to increased hiring and potentially higher wages due to greater demand for labor. On the other hand, higher interest rates may slow down economic growth, potentially leading to reduced hiring or even layoffs. The Fed's goal is to foster conditions that support a strong labor market without triggering excessive inflation. By carefully monitoring employment data and wage trends, the Fed aims to implement policies that promote sustainable job growth and stable income levels for workers. The Fed and the housing market. The housing market is particularly sensitive to Federal Reserve policies, especially interest rate decisions. Mortgage rates are influenced by the federal funds rate. When the Fed raises rates, mortgage rates typically increase, making home loans more expensive and potentially cooling housing demand. Conversely, lower interest rates can lead to more affordable mortgages, stimulating home buying and construction activity. These shifts can have broader economic implications as the housing market affects consumer spending, job creation in construction and real estate, and overall economic confidence. By understanding the Fed's influence on mortgage rates, prospective homebuyers and investors can make more informed decisions about entering or exiting the housing market. The Fed's role in financial crises. During financial crises, the Federal Reserve acts as a stabilizing force to prevent economic collapse. It can provide emergency lending to banks and other financial institutions facing liquidity shortages, ensuring the continued flow of credit to businesses and consumers. The Fed may also implement unconventional monetary policies, such as quantitative easing, which involves purchasing large amounts of government securities to inject liquidity into the economy. These actions aim to restore confidence in financial markets, support asset prices, and encourage lending and investment. By acting swiftly and decisively, the Fed seeks to mitigate the severity of economic downturns and facilitate a quicker recovery. The Fed's communication and market expectations. The Federal Reserve's communication strategy plays a crucial role in shaping market expectations and economic behavior. Through official statements, press conferences, and reports, the Fed provides insights into its assessment of the economy and potential policy directions. Clear and transparent communication helps reduce uncertainty, allowing businesses and consumers to make informed decisions. For instance, if the Fed signals an upcoming interest rate hike, markets may adjust accordingly, influencing borrowing costs, investment strategies, and currency values. Effective communication ensures that monetary policy actions have the intended impact on the economy by aligning public expectations with the Fed's objectives. How you can stay informed about the Fed. Staying informed about Federal Reserve policies and decisions is essential for making sound financial choices. The Fed's official website, federalreserve.gov, offers a wealth of resources, including meeting minutes, economic projections, and educational materials. Financial news outlets and economic analysts also provide interpretations and forecasts based on Fed actions. By regularly monitoring these sources, individuals can anticipate changes in interest rates, inflation trends, and economic growth, allowing them to adjust their savings, investments, and borrowing strategies accordingly. Being proactive in understanding the Fed's role and its impact on the economy empowers you to navigate financial decisions with greater confidence and foresight. Understanding the Federal Reserve's functions and policies is more than just economic theory. It's about grasping how these decisions influence your daily financial life. From the interest rates on your loans to the returns on your savings, the Fed's actions have tangible effects. By staying informed and proactive, you can better navigate the financial landscape, make strategic decisions, and achieve greater financial stability. Make sure to like, share, and subscribe to our channel for more informative content.